Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, what differentiates successful day traders from unsuccessful ones? Answer by Mark Montoya. Successful traders do one thing very well. They know how to lose money, or said another way, they have mastered money management. You will have winning trades and losing trades. How you handle both will determine your success or failure. You could have a 60% win rate and still lose money, or you could have a 30% win rate and make money. Win rates are completely meaningless. Most losing trades were a winning trade at some point in the life cycle of the trade. If you fail to learn how to manage the losers, you will go broke. This is a fact, not an opinion. Managing winner is the easy part, which I will get to shortly. If you focus on not losing money, instead of trying to make money, you will see your profits go up with time. That's right, your focus is protecting your capital, not making money. Easier said than done, trust me. Everyone says, keep your losses small and let your winners run, and that's all you need to do. Well, of course. But what is a small loss, and how do I know when to exit a winner? Exiting a winner is easy and can be a mechanical exercise, which I will point out below. However, knowing when to exit a loser is a much tougher question, and often is not as mechanical. I could ask 5 experienced traders this question and get 5 different answers, but they would all agree that you have to actively manage the losing trade. If you are long XYZ for 1,000 shares at $50 a share, and it starts to move against you, and you are down $700, $49.30, get out. Don't sit there waiting for it to bounce back, unless you are very familiar with XYZ and understand its trading behavior. Can't tell you how many times $700 becomes $1,000, then $1,200, $1,500, etc. You need to get out early and move on. Don't tell yourself it will bounce back. Maybe it does, but you can't take the chance. The above is just example and is not meant to imply you should take a $700 loss on a $50,000 position. You need to establish stops that work for you. Same holds for the winners. If you're up $700, trail your stop up to break even or small profit to cover fees. If it moves to $1,000 of profit, trail your stop to $700. If it moves to $1,200, trail your stop to $1,000, and if it moves to $1,500, trail your stop to $1,200. Lock in profits on the way up, but stay in the trade. The mistake is exiting the trade and not letting it run. This is how you manage winners. Keep trailing your stop up until you are stopped out, and tighten them as you go up. You can also scale out of your position, but I have found trailing up my stops is easier. That's just me. If you have been trading for a few months, 300 plus trades or more, and start to see that you are winning about 50% of the time, but you are losing money, then you're more than likely not taking your losses soon enough. You might be winning half your trades, but the losers are slowly eating at your capital. I found when I was a newer trader that I was most profitable when I am winning about 40% of the time. Remember, taking small losses means more losing trades, which is why your win percent drops and why winning percents are meaningless. Also remember that a losing trade is simply taking a loss on trade. It does not mean your analysis was wrong. We don't care if we are right or wrong per se. We are money managers, not stock pickers or stock investors. You are in this to make money, not be right. If your average winning trade is twice your average losing trade, you will make money with a 40% win rate and break even at 30%. $1,000 average winner and $500 average loser. At 40% win rate, this is $4,000 in wins and $3,000 in losses, or $40,000 in wins and $30,000 in losses for week, or month or year. As you think about what I said, you will see why this business is about the losing trades, not the winning trades. Your trading success is completely dependent on how you manage losers. You don't have to know anything about trading per se, and just focus on money management. Trading, especially short time frame trading, is mainly about money management. Answer by David Van Vliet. I can only speak for technical analysts, so I am interested in a fundamental trader's answer to this also. Successful traders have the patience and humility to learn and simulate until they know enough to go live. The strategy they employ has good stats. Speaking of stats, they typically understand the basics of it when they start. I sometimes tell people I'm a card counter. It is similar enough to technical analysis, and they don't ask what day trading is when I tell them. Anyway, I understood card counting really well before I went into trading, which helped me get into the right mindset. They didn't give up. Ever. I know a few multi-millionaire traders who failed miserably 3 or 4 times. But they didn't let the voices of limitation or failure enter their soul. They kept going. It's worth it. You're worth it. They are honest with themselves about what they are capable of and susceptible to. They don't try to force trades, they trade the appropriate percentage of their account. They know how to treat high-impact news, and all that. Most importantly, they have exact in and out rules with the discipline to stick with it. This is by far the most important part. You can have everything else in place, but if not for this little detail, the trader is merely going on hunches every time they enter the market. In that case, there are no numbers-driven reasons to trade the way they do. There is no certainty that what they are doing will bring in consistent gains over time. Emotions go wild, affecting the way they handle the trade. Then they get a weak stomach for trading altogether, which sets them back later. For example, let's say a trader knew everything they needed to know to be amazing, except they didn't have an exit rule. It jacked them up emotionally. Then they figured out some good ideas and went with, say, a rule where they exit a long position after price closes above the highest body of the highest pivot within the last 100 candles. That is just an example rule. Don't use it unless you have tested it and found it to be useful to your own system. They now have the rule in place, completing their excellent strategy, but they don't take trades with confidence. Why is this? Because they had exposure to serious nervousness. Even though they are now completely capable, their own emotions cause them to hesitate, day after day, as they see price go up to the place they would have certainly taken a profit. This is why it is so important to have exact entry-exit rules. The successful ones have it. Answer by Zach Hughes. Here is the key to understand. It comes down to a lot of luck as to what strategy that you happen to start with. Consider someone who uses the IBD Top 50 as part of their day trading strategy, and they started in 2010. They bought these stocks on the dips and they are genius right now. They're up big, but one day they will lose 50% of their portfolio when the market crashes like it always does. Or what about someone who wants to trade a specific ETF, and they follow the price movements daily waiting for it to drop to a certain level and then buy? This can work great for a while until it does not. The point here is you can run any strategy you like, but the timing of it determines if you make money. That timing is pretty well luck. So if you ask someone if they are profitable day trading, oftentimes they pick the right strategy at the right time and attribute this to skill. The better question is, what is their strategy? Which in so many words is what you're asking. If someone says they buy stocks that drop like the IBD momentum style stocks and they follow the chart patterns run, the market has performed the same pattern for years now, of course it worked. Or they use technical analysis for their trades and have profited for the last couple of years run. Here is the reality. If you take stock data and run trends on thousands of stocks, it comes back 50-50, a coin flip. That is not an opinion, it is a fact. Basically, technical analysis is crap. Every real study done on it says so. Look them up. Institutions with unlimited resources underperform the market when you look at their 10 to 20-year history. I think over 95% or better. The best thing you can do is load stock data from Yahoo Finance or Guan, run analysis on them. See what the moving average cross, MACD, RSI, support resistant lines actually pay out. You will find it is random. I try to go to as many trading meetups as I can to network with traders. None are profitable except May 1st and 20. Never meet anyone who has started day trading since before 2007. I went to a clay trader event in Columbus, Ohio last year. 20 or more people showed up. No one in there had more than 2 years experience and not one person was profitable. It was funny when everyone introduced themselves. Well, I have been trading for 9 months now, but I'm having a hard time being profitable. They thought the answer was to buy more courses from Clay. Technical traders are lucky, the numbers back this up. Flip a coin 10,000 times. Heads is a winning trade and tails is a losing trade. You will be stunned at how easy it is to be a successful trader by using a coin. You're just not going to meet a trader who has been sitting at their computer day trading for 20 years. Probability is awesome. If you do ask yourself, why was this person so hard to find?